UK Secretary of State for Business, Vince Cable, was to look at the impact of the functioning of equity markets on long-term decision-making by British companies. And that brief, and the way the brief that was framed, told me from the beginning that what we ought to be doing was looking at how markets functioned from the perspective of ultimate users. That is, the companies which make use of equity markets and the savers who derive their pensions and other long-term financial objectives through equity markets. Now, if that sounds obvious, even banal, and I think it is obvious and banal, it's different from the normal perspective that is taken in looking at financial market issues, which is to look at markets through the eyes of market participants. And much of the discussion we have about the functioning of financial markets relates to the efficiency of markets in a narrow technical sense of efficiency, which relates to market integrity, liquidity, price discovery, issues of that kind. These things are at best intermediate objectives to our fundamental goals of high-performing companies and the returns which savers ought to earn from that high performance. That perspective, even if it's unusual, is, I think, the perspective which has led to the formation and development of Finance Watch, the perspective that markets are for users, not for participants. And it's a reason why I'm very pleased to be here in Brussels today to give this particular talk. But also I've emphasised that I was asked to do the exercise by Britain's Secretary of State for Business, and I was asked to look at the impact of markets on the performance of UK companies. So what I'm going to say, because I think this is the most useful way for me to start this introduction to the afternoon, is to talk about the report and to stick for the moment with that British perspective. I may hint at one or two ways in which I think Britain differs from other EU member states and other countries, but I will not say much about that in my introductory remarks, nor will I say much about what needs to be done at European level rather than what can be done at the UK level. These are subjects that I think we need to have plenty of time to discuss in the course of the afternoon, but I think it will be most helpful if I begin by saying what is in the report and what motivated the kind of conclusions which we reached in that report. When we looked at how UK equity markets function, there were several things, some of them surprising, that jumped out. The first, and this still comes as a surprise to most people, is that as a source of finance for investment in British business, equity markets are of no significance whatever. Large companies in the UK are basically self-financing, and that is true of the corporate sector as a whole and of the vast majority of individual companies within it. Rights issues, new issues by established listed companies are basically non-existent in the UK, and if one were to strip out the rescue rights issues for the banking sector, in which the bulk of the capital was provided by the UK government, one discovers that over the last 2 decades, the net issuance of equities in the UK markets has been negative, not positive. That is, the amount of equity that has disappeared through acquisitions and share buybacks is greater than the amount which has been raised in primary markets. More than that, the IPO market, that is, new listings by British companies, are almost non-existent. Well, the situation as it was described to us by several large institutions today was of a buyer's strike. That is, that investors have been sufficiently burned by low-quality issues being made to them that they are no longer interested. And while there are quite a number of new listings on UK markets, these UK listings are not listings of UK, or indeed in most cases European companies, nor are they issues of industrial companies raising funds for investment. Put simply, the stock market as it operates today is not a means of getting money into companies, it is a means of taking it out. And there's not necessarily anything wrong with that, but it means that the role of markets is very different from the one which you get taught when you're told the basics of finance at the age of 16 or whatever it might be. The second discovery I made is that the structure of holding of shares in the UK has changed very radically. 50 years ago, most British shares were held by private individuals. That changed, and 20 years ago, the dominant holders of UK equities were British pension funds and insurance companies. But that isn't true anymore. It isn't true anymore, partly because regulation and other decisions have led these institutions to reduce the amount of equities they hold. It's not true anymore, partly because these institutions have diminished as a proportion of total savings, and it's not true anymore because many of these institutions have outsourced the activity of equity management. In the UK at the moment, the important players in the equity investment chain are large investment managers: BlackRock, Fidelity, Vanguard, Legal & General, M&G, and the top 6 to 10 institutions account for getting on for half of all ownership of British shares. The players who matter today in terms of holding shares are these long-only or predominantly long asset managers. Third discovery I made is the chain of intermediation we have in equity markets is far too long and far too expensive. I said that the people who matter in the end, the interests we should be trying to promote, are companies at one end and savers at the other. But between companies and savers, there are custodians, there are registrars, there are nominees, there are asset managers, there are fund-to-fund managers, there are pension fund trustees, there are life companies, there are investment consultants, there are platforms, there are independent financial advisors, and I could go on. And all of these people, of course, require their own legal staffs, their own compliance officers, their own auditing and accounting support, and so on. The length of that chain creates two groups of problems. The first is what it costs, because every member of that chain takes, to change my metaphor, a bite out of the cake at some particular point. And the other problem it creates is that of misalignment of incentives, because each of these intermediaries has its own business model, and the imperatives of that business model do not necessarily correspond to the interests of companies at the one hand and savers at the other. So these are three elements we need to understand, that equity markets are secondary markets, that asset managers are today the important players in the equity investment chain, and that equity investment chain is itself far too long. Well, the second part of the brief which I was given was to ask, how does this impinge on long-term decision-making by British companies? And I think it impinges in essentially three primary ways. The first, which we heard a little about in the introduction, is to do with investment. But of course, it needs to be said that one of the reasons why equity markets are not very important as a source of capital for British business is that nothing is very important as a source of capital for business anymore. Business is simply, in the modern European economy, much less capital intensive than it once was. So that tangible investment is not as significant as it once was, but that doesn't mean it doesn't matter at all. And if I look at the share of GDP that goes into business investment, I discover if I look around Europe or the OECD, that Britain is firmly at the bottom of the league in terms of the share of business investment and of R&D, business R&D in total GDP, and that the United States is generally close to second bottom of that list. It may be a coincidence that these are the two countries with the most active equity markets, but at any rate, it is something that is worth noting and worth looking at. But frankly, I'm more concerned when I think of long-term investment about, for the reasons I've just described, about investment in intangible assets than I am about investment in tangible assets. When we talk about intangible assets, we're talking, of course, about the skills and capabilities of both a company and its workforce. We're also talking about the reputations that companies enjoy with their customers and their suppliers. And I think we can see right across the corporate sector the extent to which companies have been ready in the past 2 decades to sacrifice some of that reputation in pursuit of short-term growth of earnings per share. The financial example is the extreme example, or is of course the extreme example of where that has happened. And I'll talk a bit more about the decline in relationships there in a moment. The financial sector is the extreme example. I like the comment I read the other day when someone said, quoted a poll that said that in Britain only 10% of the population thought that bankers could be trusted, to which the reaction was, you mean there are 6 million people in Britain today who still do trust bankers? These tangible assets have declined in value and have been allowed to decline in value in pursuit of earnings per share growth. That earnings per share growth takes one to what I see as the dysfunctional cycle of earnings guidance and earnings management. It's the kind of activity that is centered around quarterly reporting that creates an incestuous symbiotic relationship between sell-side analysts and the finance functions and investor relations departments of companies, in which on the one hand companies are trying to manage investors' expectations and investors are trying and analysts are trying to manage each other's expectations in ways that create an activity that may have very little connection with the underlying value and development of the business. And if you doubt that, you simply have to look at the number of cases of companies which reported steady quarter-by-quarter growth on earnings in lines with market wants and expectations until suddenly they didn't. It's an indication that what is going on is not something that is telling you about what is actually happening in the company. It's something that is being done in order to manage expectations. And I'll say a bit more about that in a moment. The third area, which is a source of problems in long-term decision-making, is what I think is best described as hyperactivity. Most of you are in the financial sector sufficiently to know that the word that is used in financial circles in London to describe merger and acquisition activity is corporate activity, which I've always thought was contrasted with corporate inactivity, which was getting on with running the business. And that is indeed the perspective which quite a lot of people take. In giving some presentations on this in the UK, I have asked the question, what happened to what were Britain's largest industrial companies of 20 years ago? Chemical company ICI, number 1. The electrical engineering company GEC, number 2. The answer is that neither of these companies exist anymore as independent businesses. The remnants of each of these are to be found scattered among a number of other mainly foreign-owned businesses, while Europe and indeed the world's largest companies in these two particular sectors are BASF in the chemical sector, and at Siemens in the electrical engineering sector. Both of them, interestingly, German companies. And that's perhaps the first issue about differences in perspective across Europe that I hope we might take up in discussion later. But hyperactivity is characteristic of a great deal of the way in which corporate executives relate to equity markets. And anyone who has much experience of talking to senior people in British companies over the last 2 to 3 decades will understand the extent to which many corporate executives are more or less obsessed with this kind of activity. There are a great many executives today who regard their jobs as being that of being a sort of meta fund manager, managing a portfolio of businesses, rather than as an asset manager manages a portfolio of stock. But that is not, in the end, what business is about, and we have a large volume of evidence that suggests that little, if any, value is added by the totality of this activity. So the concerns about long-term decision-making relate to investment and investment in both tangible and intangible assets. They relate to the cycle of earnings guidance and earnings management, and they relate to the hyperactivity around about mergers and acquisitions. Okay, we're piecing together the facts about what has been happening. It's worth saying right at the beginning that the fact that investors may have short-term time horizons doesn't necessarily mean that the companies in which they invest need do so on time horizons that match those of the underlying investors. In a sense, that would be to miss the whole point of equity markets. The point of equity markets is to allow companies to raise long-term capital without necessarily locking investors in to very long-term investments in companies. So there isn't that simple, naive connection between long-termism and short-termism on the part of investors and long-termism and short-termism on the part of companies. But nevertheless, there is a relationship, and we need to be rather clear about what it is, because we will understand better when we do the mechanisms that have created the problems we describe. I think the best way of thinking about it is to recognize that there is huge uncertainty about the evolution and development and underlying value of any large, complex, modern business. There is huge uncertainty. So let us call the value discovery horizon the time horizon on which one learns what the value either of a company or of an event that changes the value of a company is. We have then this value discovery horizon in which over that horizon, with a great deal of uncertainty and fluctuation, markets discover or could discover what the impact of the company's evolution or a change in that evolution would be. At the same time, we have what one might call the performance horizon, which is the question of what is the time period over which an asset manager is actually judged. Now, if the performance horizon is long relative to the value horizon, that is, if the performance horizon is sufficiently extended that it goes beyond the value discovery horizon, then what the asset manager is incentivized to focus on is the process of value discovery, understanding what the real value of the company is and how events in the economic environment change the value of that company. However, the shorter the period of the performance horizon, the more the asset manager will be concerned not with the actual impact on the value of the company, but on the change in market expectations about the value of the company. And the shorter the performance horizon, the more important it will be to understand what it is that other people think about the the value of the company rather than what the value of the company itself actually is. That's the fundamental point, which for me was encapsulated when I talked to a large fund manager who, talking about competitive advantages that created long-term profits in business, and he said to me, I don't want to talk about competitive advantages, I just want to know what stocks are going to go up. And that is essentially the issue we're talking about. It's the issue that has probably never been better described than in Keynes's metaphor of the beauty contest, which some of you will be familiar with, in which he described what in his day was then a kind of newspaper contest in which readers were asked to pick what was the most beautiful of a series of women's faces. And the determination of what was most beautiful was not on any objective measure of what beauty was, but on what other contestants thought, the average of what other contestants thought was the most beautiful. So you were being asked to guess not which was most beautiful, but which others would say were most beautiful. And he pointed out, one then moves into the second round of that, in which your objective is not to guess, is to guess which other people who enter the competition will think other people will think is the most beautiful, and so on and so on. He said this can go up to the fourth and fifth degree. I think at the time Keynes had no idea of the extent to which this process could actually become self-reinforcing and self-generating, and the extent to which a trading activity, not just in equity markets, but in financial markets more generally, could come to be dominated by assessment of other people's expectations and disconnected from what the underlying value of the assets and securities which were being traded was. So that's one very large dysfunctionality which we see in equity markets, a dysfunctionality which is giving rise to much of the behavior which we describe. The second kind of dysfunctionality, which is quite closely related to that, is that you will all know that the holy grail for the asset manager today is the pursuit of alpha, which essentially means relative outperformance. Each fund manager, for entirely explicable reasons, it's into their business model, the way they try to sell their product, is to emphasize their performance relative to either a benchmark or the average of the performance of other fund managers, which is, of course, essentially the same thing, since fund managers in aggregate amount to the market. But one can see very clearly the implication of that, which is that the pursuit of alpha is necessarily taken across the market as a whole. The total of alpha adds up to precisely zero. If fund managers are to improve the returns which are being earned by their underlying savers taken as a whole, the only way they can do this is not to achieve alpha, because alpha adds up to nothing. It's to achieve beta, which is the underlying performance of the asset class taken as a whole. But the benefit to any individual fund manager of that improvement is extremely small. Most of the market is, as it were, held by his competitors, and therefore most of the benefit of any activity of this kind is obtained by competitors. Okay, so these are the core dysfunctionalities of the way asset management activity in equity markets work that give rise to the kind of problems I've described. What are we going to do about it? Well, in thinking about what we do about it, I've emphasized two broad themes. The first of these themes is the issue of trust and confidence and respect. Now, we hear a great deal about trust and confidence and respect in financial markets today. You can hardly spend a few days in the City of London without there being some event to discuss this particular issue. Most of the discussion, certainly in my experience, seems to regard it as essentially a public relations problem. It is not a public relations problem. You do not persuade people that you are honest by delivering lectures telling people how honest you are. Indeed, if your experience is like mine, it's almost the reverse. When someone starts telling you how honest they are, you know that that is a moment to keep a firm hold on your purse, on your wallet. People who are genuinely deserving of your trust and confidence do not actually need to demonstrate, to deliver lectures telling you how honest they are. It's a symptom of a problem rather than the revelation of the problem. Trust and confidence and respect are generated by behavior. The reason they have been dissipated in the financial sector is largely as a result of the behavior of some people in the financial sector, and it will not change or be restored until there is a change in the behavior of the financial sector. I find it rather depressing, actually, that the new Financial Conduct Authority in the United Kingdom has as its primary goal that of maintaining confidence in the financial system. I think the primary goal ought to be maintaining justified confidence in the financial system, which is not at all the same thing. And if we were to have a pharmaceutical industry regulator given the injunction that his job was to maintain confidence in the integrity of drug companies, I think we would realize we had a mistaken interpretation of the duty which there actually ought to be. Trust and confidence, however, are essentially the product of personal relationships. In fact, they're the product either of personal relationships or of personal relationships amplified by organizational structures that are so tightly controlled and organized that we can have confidence that the behavior of any one member of that organization will be representative of the whole. These are the things that are key to establishing genuine, justified trust and confidence. And I think once one has spelled that out, one realizes the extent to which the shift from a relationship-based world in financial services to a trading and transaction-based culture inevitably erodes and dissipates the existence of trust and confidence. Trust and confidence are not generated and cannot be generated by trading between anonymous agents. There is no trust and confidence in a relationship in a dark pool because by definition there is no relationship in a dark pool. And therefore, if we are to start addressing the issues that the loss of trust and confidence raise, we have to start rethinking the way we approach financial intermediation more generally and understand that successful financial intermediation is based on relationships rather than trading and transactions. That is actually the only way that effective financial intermediation is conducted. And we have seen the mistake that was made in the mortgage market by people believing that they could, through a Salesforce computerized mortgage scoring and rating of complex securities based on mortgages by models constructed in rating agencies, the belief that this could replace the traditional method of making housing loans, which was we went along to a bank or building society or thrift manager and persuaded him that you were going to be able to repay the money. That substitution led to disaster in that market, and it has led to the problems which we are seeing right across the financial sector. So there's an issue of trust and confidence, and for me that relates directly to questions about the replacement of relationships by trading and transactions. The second group of issues relate to incentives. Now, when I talk about incentives, people's minds immediately turn to bonuses. And I'm talking a little bit about bonuses, but I'm not principally talking about bonuses. I'm making the point that was made in the introduction, which is to say that most people in most lines of business are behaving in the ways you would expect them to in the environment in which they find themselves. If people are doing the wrong things from a social point of view, then it is because the environment in which they are operating are wrong in most cases, rather than because these are particularly wicked and unpleasant people. There are wicked and unpleasant people in the financial sector, but the vast majority of people who work in the financial sector are decent people who would like to be able to get on with doing a good job. People behave as you would expect them to in the environment in which they find themselves. Now, as has already been hinted, once we accept that point, we need as profound implications for the way we think about financial sector regulation. Because the whole thrust of financial sector regulation for more than 2 decades has been to allow the creation of structures, industry structures that create perverse incentives, and then to try and draw up rules to prevent the undesirable behavior which is produced by these perverse incentives. That is a system which is actually doomed to failure. And we have responded to its failure by the view, the repeated view, that we didn't get the rules quite right, and if only we developed a yet more elaborate and complicated set of rules, we would now make the structure work. The problem is intrinsic to the flawed structure we are pursuing rather than to the rules. That's the process by which we got Basel II, which was much more complicated than Basel I, and Basel III, which is much more complicated than Basel II, and we can predict with complete certainty that when the next banking crisis hits, and it will probably not take very long to hit, we will have a Basel IV, which will be yet more complicated than Basel III. Continuing to go down this route represents the triumph of hope over accumulated experience, and it is time we started rethinking that. We need to think not about how we can derive detailed behavioral rules, but how we can address the structural problems which the evolution of the financial services sector has created. Now, as far as equity markets are concerned, I think you can see from what I've already said what I believe the right way ahead for equity markets is. I've noted that the phenomenon of the way the UK market in particular has evolved over the last 2 or 3 decades, and this has been true in the US also, has been to give primacy in these markets to the role of asset managers. I think we need to build up the role of the asset manager and to create asset managers who have the right kind of styles of behavior and the right kind of incentives to generate the kind of long-term investment and development in the capabilities of business that we all want. That means asset managers who are basically committed long-term holders of material stakes in companies, asset managers who have more focused portfolios than the ones we are familiar with, and who are, by being more focused, are in turn more differentiated from each other than the characteristic portfolios of asset managers today actually are. And if we can move towards a structure of that kind, I would like to see a great deal else in the channels of intermediation. A great many of these other intermediaries I've talked about begin to fall away because they just don't need to be there. In large part, they're there to generate layers of oversight because every time we create perverse incentives in the chain, as we have many perverse incentives in the chain at the moment, we say what we need to do is create somebody else to oversee the behavior of the people with the wrong incentives, and every additional layer of oversight creates a need for another layer of oversight. So in trying to impose more obligations on pension fund trustees, for example, we've invented a profession of investment consultants who are both there to enable pension fund trustees to do their job and to oversee everyone else in the process, and so on, and so on, and so on. What we should be doing is having a simpler, shorter, less expensive chain of intermediation that is focused around asset managers who have more concentrated, more focused portfolios that are more differentiated from each other. And that, I think, is a general approach which we ought to be adopting to the problems we all face in financial services regulation, which is that of saying, let us not try to generate a lot of rules that will govern behavior. Let us try and create the kind of market structures which we want to achieve the outcomes which we want. I think it's only if we go down that route that we will get away from the kind of regulatory structure which we have at the moment, which succeeds on the one hand in being extremely extensive and intrusive, and on the other in being largely ineffective in achieving the real end results which we're trying to achieve, the end results for market users, not for market participants. If I look, taken as a whole, at the performance of UK equity markets over the last 10 years, I see a situation in which companies have, for practical purposes, ceased to use equity markets as a way of raising finance. I see a situation in which the returns earned by savers have been extremely disappointing. And I also see a situation in which financial market participants have done extremely well. I think if one looks at that situation, one is identifying an outcome which, if it's allowed to persist, is not going to be sustainable either economically or politically. And we all have to do something about it.